The world is shifting faster than most people realize. We've lived through decades where one currency dominated global trade, reserve systems, and even confidence. But history has shown, again and again, that no single currency, no matter how strong it seems, holds eternal power. Empires fall not because they lack innovation, but because they fail to adapt when the foundation of their monetary system begins to crack. Today, the signals are flashing. We are entering an era where reliance on one currency is not just risky, it's strategically dangerous. The illusion of stability has carried us for too long. One currency can no longer represent the full spectrum of global productivity, innovation, and growth. The digital age is rewriting the rules of value, and those who cling to the old frameworks will miss the opportunities emerging right in front of them. Every major technological revolution, from the printing press to the internet, has redefined the way value is created and exchanged. The financial system is no different. Relying on one dominant currency creates a centralized vulnerability. It concentrates power, decision-making, and risk in a single node of the global network. When that node trembles, everything connected to it feels the shock. We saw glimpses of this during periods of monetary tightening, trade imbalances, and global debt crises. The lesson is clear: when the world leans too heavily on one form of value representation, it magnifies the systemic risk for everyone. Innovation, however, is challenging this imbalance. The rise of digital assets, decentralized finance, and algorithmic systems is introducing diversity to the global financial ecosystem. These are not threats, they are the natural evolution of money. In the same way the internet democratized information, technology is now democratizing value. For the first time in history, individuals can transact, store, and exchange value without the need for centralized intermediaries. This is not chaos, it's progress. But change brings discomfort. The transition from one dominant system to a multi-asset world won't be smooth. It never is. Think about how the early days of the internet were dismissed as a fad, or how electric vehicles were once seen as impractical. The same narrative is playing out now in global finance. Yet underneath the skepticism lies something profound: a silent revolution of capital reallocation. The smartest investors aren't looking for comfort. They're looking for asymmetry. They understand that wealth is created at the edges of change, not the center of consensus. The strength of any economy lies not in its control, but in its adaptability. We're entering a time when flexibility will matter more than dominance. A portfolio, a business, or a nation too dependent on a single currency becomes fragile when that currency's trajectory shifts. Inflation, debt, interest rates, they all act as invisible levers that can either strengthen or destabilize an economy overnight. The wise don't try to predict every move. They position themselves to thrive across multiple outcomes. Don't rely on one currency isn't just financial advice, it's a mindset. It's about understanding that resilience comes from diversification, from embracing the new rather than fearing it. Whether it's commodities, digital assets, or innovation-driven equities, the future will reward those who allocate not by nostalgia, but by vision. When people say, "This time is different," they're usually wrong, except when technology fundamentally rewires the system. That's exactly what's happening now. The next decades will redefine what money means, how it's created, and who controls it. This shift won't be dictated by policy alone. It will be accelerated by innovation, transparency, and global participation. The future of finance will be open, inclusive, and borderless. So, when I say, don't rely on one currency, I'm not predicting collapse, I'm advocating evolution. The purpose isn't to abandon, but to adapt, to see the opportunities forming in front of us before they become obvious. We're standing at the intersection of technology, economics, and human ingenuity. The question isn't whether the system will change, it already is. The real question is whether we will change with it. In every era, there's a moment when people must decide: will they protect the old order or invest in the new one? That decision defines the next generation of leadership, innovation, and wealth. The future doesn't belong to those who wait for permission, it belongs to those who see beyond a single measure of value. The time to think differently is now. Don't anchor your confidence in one currency, one economy, or one narrative. Anchor it in progress, innovation, and adaptability, because the future, as always, rewards those who refuse to stand still when the world is moving forward. The most powerful shifts in history begin quietly. They start when people realize that numbers on a screen or policies in a report don't create real value. Innovation, ownership, and tangible progress do. For too long, markets have rewarded speculation over substance. We've celebrated leverage more than creation. But the winds are changing. In a world defined by uncertainty and inflation, the call to action is simple: own real things. Not just assets that fluctuate with sentiment, but those that hold intrinsic worth. The things that build, power, and sustain the future. Throughout history, true wealth has always been rooted in ownership. Ownership of innovation, of productive capacity, of intellectual property. Paper wealth can disappear overnight, but ownership of what's real endures through every cycle. We've reached a point where money is abundant, but trust is scarce. Liquidity is high, but confidence is fragile. When systems stretch too far from reality, they eventually snap back to it. The ones who endure are those who anchor themselves in things the world actually needs: energy, technology, infrastructure, data, creativity. Owning real things doesn't mean returning to an old world mindset. It means redefining what real means in a digital age. Real doesn't only refer to tangible assets like land or metals. It includes intellectual innovations that have measurable impact. A company that produces groundbreaking AI solutions or develops life-saving biotech isn't just creating data, it's creating real, lasting value. It's easy to overlook this in a world obsessed with quarterly numbers. But when the dust settles, reality always wins. There's a reason cycles repeat. Human behavior doesn't change. Only the tools do. In every speculative boom, people chase what's abstract: leverage, derivatives, hype. And in every correction, capital flows back toward what's real. History has proven this pattern through every technological era. After every correction, the innovators, the ones building something tangible, scalable, and necessary, emerge stronger. They redefine industries, set new baselines, and create the next wave of exponential growth. Today, we are surrounded by transformative technologies that are as real as steel and as vital as oil once was. Artificial intelligence, robotics, genomics, renewable energy. These are not fantasies. They are the infrastructure of a new world economy. Yet the market often misprices them because it clings to outdated models of valuation. It's the same mistake made when electricity was misunderstood, when the internet was underestimated, when digital currencies were dismissed. The lesson is clear. Owning real things means having conviction in the fundamentals of innovation before the world accepts them as mainstream. We're entering an era where the line between physical and digital reality is blurring. Data is becoming a new form of raw material. Energy storage is as critical as energy production. Algorithms are becoming as essential as industrial machinery once was. This transformation means that owning real things now extends beyond the physical. It includes the systems, platforms, and technologies that sustain the digital and biological world. The most valuable assets of tomorrow are being built today by innovators who understand that real value cannot be inflated away. But owning real things also requires discipline. It means resisting the urge to chase trends that promise speed over substance. It means studying cycles, identifying true innovation, and ignoring the noise of short-term sentiment. When inflation rises or markets wobble, people rush towards safety, yet real safety doesn't lie in currency or cash. It lies in productive assets, in real innovation that can create value regardless of monetary policy. The world is shifting from consumption-driven growth to innovation-driven resilience. That's where ownership matters most. There's a quiet revolution happening beneath the headlines. A generation of builders is emerging, those who are not speculating on what already exists, but creating what will define the next century. The smartest capital is flowing toward real productivity, not financial engineering, and the greatest returns will come to those who recognize this shift early, who see that real ownership is not about status, it's about conviction in the systems that sustain life and progress. When markets correct, sentiment fades, and currencies fluctuate, what remains are the real things, the tangible and innovative foundations of the economy. The world eventually revalues them, often dramatically, because reality always reasserts itself. So own real things, not illusions. Own innovation that solves real problems. Own technologies that make the world more efficient, more connected, more sustainable. Own assets that are productive, not just priced. Because in the end, the future doesn't belong to those who borrow from the past. It belongs to those who build what's next. And when that next reset comes, and it always does, those who anchored themselves in reality, in ownership, in innovation, will not just survive, they will lead. The world is never static, it moves in cycles, economic, technological, and psychological. What seems secure today may be fragile tomorrow. What looks undervalued today could become essential in the next decade. In such a world, the greatest illusion is certainty. Markets, economies, and even currencies can shift overnight. That's why diversification is not just a financial principle, it's a philosophy of survival, and more importantly, of growth. Too often, investors chase conviction without context. They anchor everything in one idea, one sector, one asset class, or even one narrative. But history reminds us that concentration, while powerful in moments of optimism, becomes exposure in times of volatility. The most resilient portfolios and the most resilient minds understand that protection does not come from prediction, but from preparation. Diversification is how you prepare for a world that refuses to stay the same. This isn't about owning a little bit of everything. It's about owning exposure to multiple forms of innovation, productivity, and value creation. The traditional view of diversification, spreading capital across industries or geographies, is no longer enough. The modern economy is interconnected in ways we've never seen before. True diversification means owning across technological revolutions, across time horizons, and across paradigms of change. Think about it. The same way ecosystems thrive on diversity, so do economies. When one species dominates too heavily, the system becomes fragile. The same principle applies to markets. A portfolio overly dependent on a single theme, no matter how strong it seems, risks collapse when conditions shift. That's why adaptability, the ability to balance exposure between old and new, between stability and innovation, is the ultimate protection. We've entered a time where technological disruption is not the exception, it's the baseline. Artificial intelligence, robotics, energy transformation, and biotechnology are rewriting the definition of growth. At the same time, traditional assets like commodities and real estate remind us that tangible value still matters. The key is not to choose between them, but to understand how they interact, how one wave of innovation amplifies another, how one hedge strengthens conviction in another. Diversification is not a lack of conviction, it's a recognition that the future will not unfold in a straight line. It's humility in the face of complexity. It's the acknowledgement that even the most profound technological or economic insight must coexist within a larger system of unknowns. Those who diversify aren't playing defense, they're positioning themselves to capture multiple opportunities across multiple outcomes. There's a pattern in history that's easy to overlook. Every major economic transformation began with concentration. A breakthrough idea, a disruptive company, a bold experiment. But it matured through diversification. The internet didn't become world-changing because of one company. It did because a diversified ecosystem of innovators built around it. The same is happening today in artificial intelligence, clean energy, and digital finance. Each of these sectors is interdependent. Investing in one without understanding the network of others is like betting on one tree in a growing forest. Diversification also protects against human emotion, the most volatile market force of all. When fear takes over, people sell what's new and run to what's familiar. When greed takes over, they forget that every cycle has an end. Diversification tempers both impulses. It allows you to stay invested when volatility rises because your conviction isn't tethered to one outcome. It allows you to think long-term while others react short-term. Protection in this context is not about hiding, it's about positioning. It's about building a foundation that can absorb shocks, adapt to new data, and benefit from transformation rather than fear it. Innovation will not move in a straight line, it never has. But over time, it compounds in unexpected ways. Diversification gives you the time and patience to let that compounding unfold. The greatest investors are not those who predict perfectly, but those who structure their exposure to survive and thrive through uncertainty. They understand that volatility isn't a threat, it's the price of progress. By diversifying across industries, geographies, and technological frontiers, they reduce risk without sacrificing opportunity. They let time and innovation work in their favor. So, when the world feels uncertain, when markets shake, currencies weaken, or headlines create fear, remember that the answer is not retreat, it's diversification. It's spreading your confidence across the forces that are shaping the next era, not anchoring it to one outcome from the last. The future will reward those who embrace complexity, not those who hide from it. Diversification isn't just protection from loss, it's protection of vision, of conviction, and of opportunity, because in a world defined by disruption, the safest position is not on the sidelines. It's being intelligently diversified across the frontier of what's coming next. Most people think in days, some in quarters, a few in years, but the rare ones think in cycles. They understand that progress doesn't move in straight lines, it rises, falls, resets, and rises again, each time from a higher base. Thinking in long-term cycles is not just a strategy, it's a mindset. It's how you see beyond the noise, beyond fear, beyond the temporary chaos of markets or policy shifts. Every generation faces a moment when the old systems strain under the weight of innovation, and those who can zoom out, who can see the arc of history forming, are the ones who capture the next era of growth. We're living in one of those moments now. Technology, demographics, and capital are aligning in ways that haven't happened in decades. Yet too many are focused on headlines instead of horizons. They anchor their expectations to short-term movements, interest rates, quarterly data, political soundbites, and in doing so, they miss the bigger narrative unfolding underneath. Long-term cycles are where real value is built, because that's where innovation compounds. Every major transformation in history began with a moment of disbelief. The Industrial Revolution, the Internet, the digital economy, all faced skepticism. But those who thought long-term saw patterns, not panic. They recognized that disruption doesn't destroy, it reorders. Each technological revolution resets productivity, redistributes capital, and rewrites what society considers possible. These resets are not accidents, they're natural parts of long-term cycles. Right now, we're in the midst of multiple overlapping cycles: monetary, technological, and psychological. The monetary cycle reflects decades of debt expansion and policy intervention. The technological cycle reflects exponential innovation in AI, robotics, energy, and genomics. The psychological cycle reflects how quickly people adapt or resist these changes. When these cycles converge, volatility increases, but so does opportunity. The short-term view sees turbulence. The long-term view sees transformation. Thinking in long-term cycles requires patience when others demand speed. It requires conviction when data looks contradictory. It's understanding that true compounding doesn't happen in weeks. It happens in decades. Every major innovation goes through three phases: disbelief, adoption, and inevitability. The investors and builders who thrive are the ones who stay consistent through all three. They understand that market sentiment often underestimates exponential change because it's conditioned by linear thinking. Look at how innovation behaves. It moves quietly for years, then suddenly redefines everything. The same pattern occurred with semiconductors, with the internet, with renewable energy. Now it's happening again in artificial intelligence and automation. The adoption curve always feels slow at first, then unstoppable. The lesson is timeless. Short-term volatility is often the price of long-term transformation. Long-term cycles also demand flexibility. They teach us that what works in one phase of the cycle may fail in the next. Monetary policy, for instance, moves in long arcs. Expansion, contraction, stabilization, and reset. Innovation cycles follow similar rhythms: experimentation, disruption, scaling, and integration. To thrive, we must position ourselves where those curves intersect, where innovation aligns with economic necessity, that's where exponential returns emerge. But long-term thinking doesn't mean blind optimism. It means disciplined optimism. It means recognizing risks but refusing to let them overshadow structural progress. The world will face recessions, corrections, and crises. That's inevitable. But history shows that innovation doesn't stop, it accelerates through adversity. During every downturn, the seeds of the next boom are planted. Those who think in cycles aren't surprised by volatility, they use it to accumulate conviction. It's tempting to believe that the present moment is unique, that the challenges we face are unlike any before. Yet the rhythm is familiar. Every generation overestimates short-term risk and underestimates long-term opportunity. That's why thinking in cycles gives you clarity. It separates signal from noise, transformation from distraction. When the market is fearful, when narratives turn pessimistic, that's usually where the next phase begins. Innovation doesn't wait for comfort. It thrives in uncertainty. The greatest opportunities come not when the world feels safe, but when it feels misunderstood. Those who recognize this, who think in decades instead of days, become the architects of the future, not the victims of it. So think long term. Study history, but invest in the future. See cycles not as threats but as renewals. Each downturn resets expectations, reallocates resources, and rebuilds foundations stronger than before. That's the rhythm of progress. That's how economies, technologies, and societies evolve. The short-term view will always be crowded, emotional, and reactive. The long-term view will always be quieter, but infinitely more rewarding. Because when you align with cycles instead of fighting them, you stop chasing moments and start compounding meaning. The world rewards those who can see beyond the present. Those who think long-term understand that every ending is just the beginning of the next cycle, and that the future, as uncertain as it may seem, always belongs to those who dare to look farthest ahead.